Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. As you can see, the downside had been given a testing throughout July and August, but the low water mark on the 18th of August was pivotal to the construction of what happened next, as the market failed to break down through the neckline, currently 817, with a big old 50% Fibonacci line of the October 21 to January 22 move, spinning on its own axis with a pipe bottom and subsequently moving higher. At the time, I suspected the next significant event would be the second week of September, when the then declining short-medium moving average, currently 895, was to impinge upon the market. Well, for about a week, this moving average tried to cap the market's rise, but it all ended in failure, as 3 weeks ago the market broke higher. In all this time, since late August, the market had been constructing a new pattern, a bull channel. That's currently 930 to 998. Now, this was easy enough to do once prices overcame the short-medium moving average, as there was a limited free zone above all the way up to the July 2012 high at 957. However, last week the market reached the 957 area and I thought there might be issues. You see, 957 is the gateway to the congestion area between 957 even and 1001, within which sits the slowly rising long moving average, currently 979. A lot of this congestion was made up from 2011 and 2012 and was easily breached on the way up in February and on the way down in June. However, at those times they did not have the additional reinforcement of this long moving average, and it is this, along with the upper bull channel line, that is constraining the market this week. Now, two final points. Firstly, keep creeping in from above. We have the medium moving average, currently at 988, which can provide additional reinforcement and resistance, though given today's action it doesn't seem to be able to do that on a non-closing basis at least. Secondly, and somewhat surprisingly, is the bullish factor that we had a weekly key reversal up here last week. This gives an added spurt of bullish enthusiasms and at the very least gives further backing to the bull channel idea. Minneapolis wheat. This market has been a sideways to lower channeling market over July and August, and most definitely not as exciting as earlier in the summer. 3 weeks ago we saw the start of another bullish pattern being constructed. This pattern seems to have been prompted by the approach at a steep angle from above of the short medium moving average, currently 923, and rather than acting as a cap on any rise, it instead acted as a trigger for a move higher, such that last week and again this week prices overcame the 50% Fibonacci line, the August 2020 to May 2022 move at 956, and have been testing the combination of the November 2012 high and the 50% Fibonacci line of the December 2020 to May 2022 move at 974, as well as the September 2012 high at 986. There is now the rudimentary construction over these past 4 weeks of a bull channel come ascending expanding wedge pattern. That's currently 951 to 1017. I called this construction rudimentary last week, not only because it was at the time rudimentary, but also because the market is way behind both Chicago and Kansas City in its construction of such a bullish pattern. You only need to look at where the ever so slowly descending long moving average is at, which is currently at 1033, and the declining medium moving average, currently 1026, and the distance above the current market to appreciate how backwards are the actions here. Last week I highlighted the possibility of a dead cross of these two moving averages. Well, we did have a dead cross, but it was only just, with the long moving average just managing just to maintain a little drop, a 1 cent drop, to qualify it as being declining. But it's a poor dead cross, that is for sure. Anyway, the market now above the 50% Fibonacci line and challenging the September 2012 high at 986, it seems we may see the market test the upper trend line, which will be interesting as we have the declining medium moving average just about to intersect with it. We now have congestion above at 1034 from the July 2012 high and of course the long moving average. However, the next congestion area above is between 1055 and 1083. I have a suspicion that this area may not be that great a resistance. A lot of it is Fibonacci related, and what isn't, well, it dates from 2011 and 2008, having been broken on both the way up and down. I would add a question mark to those levels in my mind for now. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.